This example will illustrate the 4 closing entries. The first closing entry: prepare the closing entry for Happy Smiles Corporation, who had sales revenue of $55,200 and interest revenue of $4,200. So the first closing entry is always to close out revenue to income summary. So the first thing we do is close out revenue to income summary. Remember, income summary is just a temporary account that's used only during the closing process, and it's really just a placeholder account. So we look at the 2 different categories of revenue that the company had. They had sales revenue and interest revenue. So typically when we record revenue, we credit revenue. Revenue has a normal credit balance, but in this case, we're trying to close out revenue to get it back to 0. So instead of crediting it to record revenue, we will debit revenue to reduce those revenue balances down to 0. So we will debit sales revenue of $55,200, debit interest revenue $4,200. And then since we're closing those balances or moving them over to income summary, we credit income summary for the total amount. That way our journal entry will balance. So the total amount there is $59,400. So after this journal entry takes place, revenues will equal 0. So if we were to look at T accounts, and I'm just going to be generic and say that there's just a T account for revenue and then a T account for income summary. At this point, revenues would have a 0 balance and income summary would have a credit balance of $59,400. So after this journal entry takes place, revenue is closed out. The second closing entry: Happy Smiles Corporation incurred rental expenses of $17,500, salaries expenses of $18,950, utilities expenses of $7,800, and interest expenses of $750. Prepare the closing entries for these expenses. So the second closing entry is always to close expenses to income summary. So the way that we'll do that, remember when we record expenses, we always debit the expense because expense accounts have a normal debit balance. But if we want to reduce all of those balances to 0, then we have to do the opposite to reduce the balance. So we will credit all of the expense accounts. So if the expense accounts are our credit, then income summary has to be our debit. So we will debit income summary and then credit all the expense accounts that are listed. So rental expense, salaries expense, utilities expense, and interest expense. Remember, these are our credits, and so we will enter the credit amounts. For rent, it was $17,500, salaries $18,950, utilities $7,800, and interest was $750. So now to make our journal entry balance, we total up all those expenses, and that total amount is what we're debiting to income summary. When we add all of those up, that total is $45,000. So now at the end of this journal entry, all of the expense accounts will equal 0. So revenue accounts that we looked at in the first closing entry have been zeroed out. Now expenses with this journal entry have been zeroed out. All revenues and all expenses have been moved to income summary. So at the end of this journal entry, income summary will be equal to net income. Because remember, net income is just revenues minus expenses. And if we've now moved all revenues and all expenses to income summary, then that will also be equal to the net income. The third closing entry is to close out the income summary account. So if we think about the past two closing entries, we closed out revenues, which were $59,400. We closed out expenses, which were $45,000. So what now sitting in the income summary account is $14,400, which remember this is also equal to the net income for the year. So now in order to close income summary to retained earnings, we will debit income summary and credit retained earnings. And effectively what this is doing is adding the net income for the year to the company's retained earnings. And so that amount is $14,400. And just to clarify really quickly, because you might see different language on other resources within the module, the example that your textbook uses the equity accounts retained earnings and dividends because of the structure of the particular company. But other company structures, like legal structures, for example, if it's a sole proprietorship instead of a corporation, sole proprietorship has different names for their equity accounts. So on some other resources that I've posted, if you see capital instead of retained earnings or drawing instead of dividends, that's why. They're just different equity account names, but that still overall represent the same things that are going on in terms of closing the entries. So what has taken place now after this is if we just want to take a look at the income summary account overall, at what has happened to it in the past few transactions, and remember this is the only time we use income summary, is just for the closing entries. So the very first thing that happened was we closed revenues to income summary. And in doing that, we credited income summary $59,400 because we closed revenue there. The next entry, we debited income summary for $45,000 because that was the amount of the expenses that we were closing. So at that point, the amount in income summary was $14,400, which again I said is the net income. Then when we did this entry here, you'll notice that we debited income summary because we were closing it out. And so now at the end of this entry, income summary has a zero balance, and so it has now been closed out. So we've closed out revenues, we've closed out expenses, now we've closed out income summary. So the last entry that we have to make, the fourth entry in the closing process, is to close out dividends to retained earnings. Net income increases retained earnings. Dividends decrease retained earnings because dividends represent money that goes out of the company to the owners. So therefore, if owners are taking money out of the company, that's reducing the retained earnings of the company. So fourth entry is to close out dividends to retained earnings. Very simply, we will credit retained earnings because we are reducing retained earnings since we're showing how those dividends have gone out of the company, therefore reduce the retained earnings, and we credit dividends to zero out that balance. And the amount of dividends were $8,900. So that is the fourth closing entry. So now at this point, revenues have a zero balance, expenses have a zero balance, income summary has a zero balance, and dividends has a zero balance. All of those amounts have now been moved to retained earnings, which is a permanent account, and all the temporary accounts have been closed out to zero. And this is just an overall, it shows all of the entries that we just went over, and this is a resource that is also posted in the module so that you can take a look at it on one sheet of paper.